All right. It's 11 o'clock and we'll get started on our session. Want to welcome everyone here today. Um, Welcome to our post year end tax update. Um, we have some great panelists, my fellow partners, Greg Lacasse and Melissa Braun. I'll be moderating. My name is Brendan. If you have any questions for us, please use the chat feature. Um, Excuse me, please use the Q&A feature so we can monitor your questions and we'll do our best to get right back to you. Um, Throughout the day, or excuse me, throughout the presentation. And if we have to, if it's a detailed question, we might ask you to stay on later, or we may follow up with you. But but I want to thank everyone for coming today. We physically are three of us are physically in Hartford, our Hartford office, and I could say driving in this morning was a nightmare with the snow and the traffic and all that stuff. So hopefully everyone is safe in their commutes. And if you're home or working remotely, more power to you. So with that said, let's get going. I want to introduce our presenters. Again, I'm Brendan. Greg Lacasse is a tax partner along with Melissa Braun. We do a lot of work with real estate and construction and family-owned, closely owned businesses. We dabble in nonprofits, although our firm has a very large nonprofit group. So we've got a large, um, a wide breadth of experience, and a number of these. Although we're talking about taxes and tax planning and things we can do post year end. A lot of this applies to both taxable and nonprofit entities. Um, so with that being said, why don't we get into it? Um, our first part of this is really once the December 31st year end for those that are calendar year ends has come and gone, and as we embark on 2026, there are still things we can do today that affect 2025. And we're going to go into a number of those. And it's important that we consider all these for tax planning purposes. So with that being said, I'll turn over to our first slide.
All righty. Thanks, Brendan. Appreciate the introduction. Thanks for everyone on the call today joining us. Appreciate your time and attention and interest in what we're presenting today. I'm going to start out with, as Brendan had mentioned, we're focusing on what can we do now that the tax year is over for many of us, assuming we all have calendar December 31st year ends. Wanted to cover some opportunities. Again, retirement and health savings contributions. There's still time to potentially secure a 2025 tax deduction, and quite possibly, if you're newly formed or you have previously not adopted a retirement plan, there is still time for certain types of retirement plans to do that. It is close to, it is actually as far away as the extended due date of your tax return. So if it's a business adopting and it's a S corporation or a partnership, some of these plans might be able to be formed before uh, September 15th of 2026, or individuals uh, established by October 15th, 2026. So lots of time to plan and potentially get a deduction. So I'm going to cover a couple of them. There's the SEP IRA, which allows for 25% of compensation or 70% uh, or up to 70,000 in total deduction, depending on what the share of net income is. There's a solo 401k. The only drawback to that, if it's not established, is that if you're in a W-2 employment scenario, you may not be able to take advantage of the employer portion of the contribution, which would need to have been funded by the end of December 31st, 2025. But there may be an opportunity to do a profit sharing component to that. And again, that extension is out to the extended due dates for a solo 401k plan as well. Cash balance plans, if established by 2025, you can fund them up to the extended filing deadline. And that's true of existing plans where it does allow even a cash basis taxpayer to accrue a deduction into 2025, even if it's paid in 2026. If for planning purposes as well, perhaps you don't have a cash balance plan and one hasn't been established in 2025, that's another opportunity to explore for certain types of business owners that potential advantage to supercharge your retirement plan. If you're nearing retirement, it's a good vehicle. So certainly, if any interest in that topic, we can certainly talk one-on-one. IRAs and HSA cutoffs are April 15th of 26. So you do have time if you do qualify for traditional, or which traditional IRA comes in the form of deductible and non-deductible based on adjusted gross income levels for individuals, and potentially a Roth IRA, as well as HSA contributions. So if you did not max out your HSA contribution during the calendar year of 25, then you may be eligible to get an additional deduction by funding it by the April 15th deadline. And then this is always a good time to look at retirement planning in general, where you could potentially, if your adjusted gross income is too high and you can't fund a Roth IRA, a traditional Roth IRA, you may look at a backdoor Roth strategy, which is setting up a non-deductible IRA followed by a Roth conversion. Now there are some tax traps in doing this, so you have to have careful planning, because when you look at any IRA conversion, you have to aggregate all of your IRAs together to determine the taxable portion of the IRA rollover. So any questions and any questions so far, comments before we move on to the next topic? Anything you want to add in, Brendan?
Great. Yeah, just I'll put my 2 cents in. When we have very profitable businesses that we're working with, the solo 401k works generally when there's one person or very few people solo working in the business, but you can supercharge the amount of money you're putting away for retirement. So the solo 401k is a great option. And then the cash balance plans can be, for the right business, can be just wonderful savings vehicles. So please consider that, or talk to us about it if you're having a good year. All right.
Okay. Let's move on. All righty. The next thing we tend to look at for all of our clients, and we do this consistently and proactively, it's always looking at accounting methods, in certainly what method you're using to report taxable income. As you may be aware, there's certain methods that are required for your internal financial statements or financial statements issued to banks for lending purposes. However, they don't always need to conform to what you report to the IRS and other state jurisdictions. So we have opportunities to plan accordingly. Um, Currently, the IRS allows you to use the cash method of accounting if your aggregate prior 3 year sales were 31 million or less. That number is adjusted to 32 million for 2026. But that is something that we proactively look at. And sometimes a switch from accrual basis to cash method will generate what's called a 481A favorable adjustment, which means that you significantly can reduce your taxable income and obtain a deferral of your taxes. Conversely, there may be a need if your sales are going to exceed 31 or 32 million in 26 to switch from the cash method to the accrual method, which, even if detrimental, still allows some planning opportunity to spread the pain of that change over several tax years. And along with that, there's certain other items that need to follow suit in terms of capitalizing certain carrying costs for inventory and other methodologies that come into play, specifically in the construction industry and certain long-term contract manufacturers, where you might have to change from a completed contract method to percentage of completion for your accounting method for contracts. So that's one area that we tend to focus on quite a bit. The other, I would say, is in inventory methods. There are a whole host of what we call automatic changes that the IRS will accept along with the 2025 filing. So there's opportunities to explore different inventory methods. And in certain cases, certain industries, it makes sense to adopt a LIFO inventory method, which could help with tax deferral. And then we also focus on the fixed assets in the business, which include the capitalization policy, which follows along with the IRS has certain rules in terms of what expense you can, what level of asset additions could you write off based on your financial statements. So if you're issuing compilation or reviewed statements, you could establish a policy of writing off $2,500 per item for individual invoiced item for a fixed asset addition. If you have an audit required, that can be a much higher threshold. We also look at depreciation methods, and for certain instances where we're onboarding new clients, we always look at depreciation methods, and we have oftentimes found, in permissible methods used in the past, that if we convert to a permissible method, yields some savings opportunities as well. So definitely some opportunity there, in a good focus of what we're really working on with our clients during the year.
That's some great points. I would just add, Greg, that a couple of things. One, these are generally timing differences. So whether you get a benefit now, you may end up paying for that later down the road. So you got to think about that with these changes.
Yeah,
But
and
go ahead.
yeah, I would certainly agree with that. And sometimes it's not always just about tax savings. Sometimes the conformity itself helps to plan and run your business better. Certainly, converting from cash method to accrual might be more helpful in terms of planning taxes and cash flow planning, et cetera, with kind of matching the tax implications along with what you're reporting out on a quarterly basis for financial statements, et cetera. So it's not an all or nothing,
Yep.
strategy.
Yep. Good point. And my second and final comment is if so, just to reiterate, if you change accounting methods and and you want to think about this, but if there's a favorable adjustment where I'm going to be saving a bunch of tax, that's great. I can generally take that one-time adjustment in the current year and save taxes. The flip side is if it's an unfavorable adjustment where I have to report income and pick up income or reduce expenses, so it's unfavorable, I can generally spread that out over 4 years. So it's a nice option for businesses. That's all. All right. Roll depreciation.
Yes. So, couple things. One I'd like to focus on is anytime you're acquiring a building, and again, these tend to be commercial use buildings that are, have, a lot of infrastructure within the building, HVAC, office space, a lot of components, not typically a warehouse uh, per se, but more of a manufacturing facility or other types of offices where um, it's really tied into the use of the business and operations in a closely held business scenario. What's called the cost segregation study makes sense where you're looking at the structural components of the entire building, and through a study, very detailed study, you're segregating portions of the building that are eligible to be written off or deducted through depreciation over a much shorter period than what the normal IRS amortization period calls for, which is 39 years for a commercial building, 27 and a half for a residential rental. So certainly can be some uh, potential savings, and something that can actually be done after the building's been placed in service and can be made as an adjustment through a change of accounting method, as we mentioned before, and will oftentimes yield what's called the 481A favorable adjustment.
So just to reiterate that, I let's pretend I'm a manufacturer. I bought a building 2 years ago. I didn't go through this analysis. You're saying I can today for even for my 2025 taxes potentially, I could do this analysis and potentially capture those missed depreciation deductions.
That's correct. As long as we have the study documented before the extended due date of their 2025 tax return, then we can certainly take advantage of that.
That's great.
Um, in general, it's still a great time to go through your fixed asset list, whatever you have maintained on your books. Certainly, we find time and time again when we ask clients to review their list, you always find a few that, hey, we got rid of that 2 years ago, or we traded that in, or we scrapped this piece of equipment. It was worthless to us. That's important for not only federal tax savings, but certainly if you're in a state like Connecticut, and your local town assesses property taxes on it, it's certainly to get that off of the assessment list or assessment roll would be positive to save some indirect taxes, as well as if you're providing a list of assets for insurance purposes. It's certainly good to have a very clean list of what you have actively in use or still on the facilities or property of your business.
Good point.
Um, and then certainly looking at depreciation schedules. Uh, Certainly, we're this tends to again be with clients we onboard occasionally. We'll find incorrect depreciation methods, or if tax depreciation is maintained internally by our clients, then we certainly will review the methods that they're using to make sure we're using the proper methodologies. Um, a couple of changes that are effective for 2025 with the One Big Beautiful Bill Act that was passed in mid July of 25. So effective for January 19th, 2025. So any asset that was acquired uh, after that date um, and placed into service is eligible for 100% bonus depreciation for federal purposes. Not all states conform to that same methodology, but for federal purposes, you have that opportunity. And then Section 179 was set to is now raised to 2.5 million with a $4 million phase out. So, assuming you're putting in, you've purchased more than $4 million, what will effectively happen is there'll begin to be a phase out, so you lose some of the $2.5 million deduction over time. But even so, you could still potentially take bonus depreciation on those assets.
So effectively, in general, if a business buys new equipment, there's a way to completely write it off in the first year versus
That's
spreading it out over time.
that's correct. And and one thing I will comment on is uh, even though the option exists out there to write off assets in 1 year, it doesn't always mean that that will be our recommendation in certain instances where there's potential alternative minimum tax issues, or there might be limitations on income and what you can deduct over during the year. There might be reasons not to. So that's again something that may not always be transparent, but we look at it from both angles. What's most favorable, current year and future year as well.
Gotcha. All right. Next slide. Interest.
Interest deductions.
Hmm.
Um, the one benefit with the One Big Beautiful Bill is that they have uh, essentially made the business interest deduction limitation in a more favorable calculation, looking at it from an EBITDA uh, standpoint, which essentially means that there's an IRS test that looks at your adjusted taxable income now on an EBITDA basis and determines how much interest expense that you're allowed to deduct during the year. Uh, so this is now, with this change, is now, if a business was limited in terms of how much interest expense they could deduct, there is some favorability here, and that's something that we are looking at as well. There's certain types of interest expense that doesn't apply to this threshold, such as auto dealers and floor plan interest that they pay on their inventory or for carrying their inventory. So that interest is not applicable. But in addition, I did mention prior that the IRS has a limitation on who can use a cash method of accounting in this threshold of 31 million for 25, 32 million for 26. But those same thresholds also come into play in terms of the interest deduction in thresholds in terms of uh, looking at the limitations. And for certain clients, we have that own multiple businesses or have multiple investments in a mix of different business ventures. That this test is actually applied, in aggregated at an individual level. So it's something that kind of slices both our business tax planning and also our individual planning. I'd say that we probably spend more time in this area dealing with our real estate investors. It's more apt to be in those situations where they have large depreciation deductions and interest deductions as well. We don't tend to always see it in our traditional other trader businesses such as construction, manufacturing, distribution, but not to say that it can't happen, but we don't tend to see it as much in those industries.
Yeah.
All right.
Pass through entities.
Pass through entity tax. So the one thing that the one big beautiful bill did change is this increased assault cap. But for many of our clients, and we'll cover the salt cap a bit later from an individual's perspective, but this is still a strategy where we do have extension due dates coming up for our S corporations and partnerships that are March 15th. But as we're looking at our pass-through entity clients, and if they had a more profitable year for 25 versus 24, it might make sense to potentially make the PTE election, where essentially a business can pay for the tax that is owed on the profits that it generates and passes through to the business owners. In making this election essentially allows the business to get a federal tax deduction that's much more favorable than taking the state tax expense as an itemized deduction. So certainly this is something that we model together and along with the new salt cap. I would say more often than not, it certainly makes sense to make the PTE election. There's certain thresholds. Usually, there's a cutoff, but it's usually around the $100,000 mark. It usually makes sense to make this election. In some,
Sorry, go ahead.
and I just wanted to point out some states require the election for claiming the PTE election to be filed by March 15th to elect it for 2026. Others will allow you to retroactively make the election for 2025. So just want to be clear on that it's not uniform for all states in question. It's there's some differing rules by state.
So this is a couple comments on my end. This applies to business owners of a pass-through entity, so a LLC partnership, S corporation, and So it doesn't apply to C corporations.
No,
Um,
nor sole proprietors
right.
either. So
So if you're a sole proprietor, maybe consider adding, if you're an LLC, adding an owner so that you file a
yeah,
pass-through entity tax return, or consider electing
S
S
election.
status, an S
Yep.
election, to get this benefit. So it's a great benefit. Melissa's going to go into it a little bit later, but again, it's so for those that don't know, SALT, state and local tax. It's the taxes you potentially could deduct your state income taxes you pay, property taxes on the house, property taxes on the cars. There is a $10,000 cap. It's expanded. I don't want to take any wind out of Melissa's sails, but we'll go into it later. So it's a great. So if you do have a pastor entity, this is a great thing to consider.
All right.
All right, couple more.
Yeah. Yeah. Um, couple couple things about some remaining energy credits. For the most part, the one big beautiful bill is really put an end to many of these credits. And there's a few that are remaining that are phasing out, but worth noting. I think for the majority of these credits, I think they were probably most people have planned them out, whether they're going to buy uh, you know renovate a building where you would have energy efficiency, or for certain home builders, uh, uh, you know uh, planning out these credit strategies, or solar projects. For the most part, I think with the changing in these credit rules, I think most people got ahead of this. But I would be remiss if we didn't mention it, that there still is the ability to claim some of these credits. The 179D is actually a deduction, but it's been repealed for construction beginning after June 30th of 26. So certainly want to check to see if you're going to miss that window. The action to take would be, to get a contract in place. 45L, uh, again, eligible home builders can receive the credit for energy efficient housing. Uh, but again, this terminates as of June 30th of 2026, as well as the solar credit, which does have um, uh, a placed in service requirement that has a deadline of December 31st, 2027. But the sooner the uh, solar energy equipment is placed in service, the more favorable the credit. There is a phase down of that credit over time.
All right.
Okay.
R&D.
R and D, some substantial changes from the OBBA, and this is actually for many of our manufacturing clients, and from time to time, even construction. We are having continuous conversations about these capitalized costs. So uh, prior to 2024, the IRS required all research and development costs to be capitalized and amortized over 5 years. And if it was foreign-based research, would be capitalized and amortized over 15 years. So even though these costs may have been eligible for an R&D tax credit, it still whipsawed a number of businesses where they uh, ended up generating lots of taxable income, still receiving the credit, but the value of the credit was diminished significantly because of the add back rule. So favorably, there is a new section added, 174A, which focuses on domestic R&D costs and essentially for beginning for tax years after December 31st, 2024, now allows the best of both worlds where you can deduct the R&D expenses and claim the credit. Um, so that there's definitely some favorability, but there are some transitional rules that are in place that if you had previously capitalized these expenses, there's uh, different tax treatments in options on how you treat those prior uh, uh, prior incurred capitalized costs and how you treat them going forward. So even though you can start writing off expenses in 2025, there are some methods available in terms of how you want to treat the historic costs because there might be some opportunities to accelerate those costs into 25 or potentially spread them out over 2 years and deduct 50% of the remaining over the 25 and 26. Um, and there's other accounting methodology changes, or there could be different adoptions of other rules if it makes sense in relation to the business. So again, might change depending on if a business has net operating losses or other planning strategies where maybe you'd want to continue to capitalize. But it, again, it's case by case, taxpayer by taxpayer in terms of what would make sense for each respective client or taxpayer. Um, and then
Great.
just the last bullet, and then I think we're up to a polling question. They have increased the documentation required in tracking R&D activities. So we're often surprised when we talk to business owners that do you do any R&D, and they sometimes they don't think they do, but when you really start drilling into what they do on a daily basis, very often you do find opportunities there. So certainly for those that are doing anything that's discovery or trial and error or those types of activities in their uh, manufacturing or construction business or even in software, uh, there may be a benefit.
Great. So true. It's often missed. We find that a lot, especially when we pick up new clients. It's a great, it's a great benefit.
All righty. So
All
I
right.
think we have a polling question coming up, and then I'm going to hand it over to Melissa.
Yeah.
So thanks everyone.
Have you elected the P-TECH credit? I have not. I don't have a pass-through entity, so I'm gonna.
Well, the polling question is up. We did have one question that came in when Greg was talking about the pet credit. So the question is, does it apply to worker owner co-ops? So it depends. I know that's not the best answer. We'd have to look at your structure. But it depends on what you actually organized your federal under in order to be able to determine if we could take the pet for
Yeah,
the state.
yeah. And I would say generally it's no.
Right.
Most worker co-ops are filing as a 1120 C, which is a hybrid corporation, so to speak. So generally, no.
Well, all right. So certainly plenty of folks said yes, but most said no. All right. Let's hop through to part two, strategic planning for 2026. Turn it over to Melissa.
All right, so here's just a couple things to keep in mind while you're going through your 2026 adventures this year. There's permanent brackets now for the 37% top rate, and the TCGA style brackets are now permanent. So when you're doing deals or trying to figure out your tax rate, we have a permanent tax rate to go by. The standard deduction is also rising, so it'll be 16,100 for single and 32,200 for joint. And kind of the biggest change is the new senior deduction. So there's an additional $6,000 deduction for those who are over 65. There is phase outs to be aware of. So you can see the phase outs there at 75,000 for single or 150,000 for joint. So just something for high income seniors to kind of monitor, because a small reduction in your income could kind of take away from the $6,000 benefit or make it completely disappear, and you also should be in mind of your adjusted gross income when you're looking at the cost of Medicare premiums that'd be coming up for the year.
Right. Melissa, the just on the first bullet point, the permanent, so the 37% rate, it was scheduled to go to 39.6, right? So we got about a
Mm-hmm.
2.5% savings on the top rate, but I think that also pushed down through the other brackets as well. All right.
All right. So next is kind of this is the itemized deduction slide. So itemized deductions are capped at 35% starting in 2026. So if you are in the 37% bracket, just be in mind that you're losing 2% of all your itemized deductions that you're taking for the year. This kind of comes more into play. I think the biggest impact for planning purposes is kind of your charitable contributions. So there is a floor now. So now there's a cap and a floor for individuals. There's always been a cap for corporates, but now for individuals, we got a cap and a floor. So contributions have to exceed the 0.5% of your adjusted gross income to be deductible for 2026. It's basically lose that 0.5% going forward. And then you only can use, if you're in the 37% bracket, you can only use the benefit of 35% related to your charitable contributions. So that's if you can itemize. If you can't itemize, there is an above the line deduction available now. So it's $1,000 for single, $2,000 for joint, going forward if you're not allowed to itemize. Kind of to keep in mind for those who are over 70 and a half, instead of taking your retirement distribution or your normal distribution, you can just have it sent directly to the charities that you usually do every year, or you've got an idea or you're bunching them up. And this becomes a qualified charitable distribution. And this reduces the amount that, kind of gets taxed above the line and circumvents the itemized deductions and the entire phase out of the AGI issues that you might run into.
Great.
The next is our favorite conversation of SALT.
The salt cap.
The SALT cap. So there's an increase for 2026. So the SALT cap is 40,400. But if you are a high earner, you face a 30% reduction for income over the 505,000. So essentially, once you hit 505,000, the floor ends up, or you don't go below $10,000 deduction, but you start reducing from the 40,000. Typically, it's completely phased out around like 600-ish thousand. You'll act like everything's normal, that you've had for the past few years, where the SALT tax limitation or SALT tax deduction is $10,000 if you end up being a high earner. So one of the things to think about is the pet elections that will help bypass the limit. We generally encourage the pet deductions when you're in the high income brackets, to kind of circumvent this and make sure you get your deduction for state taxes. And typically when you're up here in the Northeast, when you're paying your Connecticut property tax and your Connecticut income tax, and you're already paying 40,000, so the pet deduction is always worthwhile.
Yep.
And then something you can think about if you're trying to plan your state deductions and you haven't hit that that limit, you can always double up on your property tax payments and kind of get the itemized deduction every other year. It'd be something to think about.
That's interesting. So just to expand on that, so you're saying because of all these limitations and stuff, and depending on my income level, maybe I double up on either charitable contributions or property tax payments to kind of bunch them up into one year where I can take advantage of a higher itemized deductions, knowing that in the following year I'll still get a solid deduction, the standard deduction, but certainly bunching might make sense.
Yep. And we had one question come in about, is it still income tax or sales tax? It is still either or, it's not both.
Yeah. Yeah, that has not changed. Good point.
I think we are on to the next polling
All right.
question. Oh,
Nope.
maybe not.
So, and I don't know, I'll take this one, Melissa, if you don't mind. So,
Sure.
so this is rare, but we want to point it out. There's a new section of the law generally relating to manufacturing. And so if manufacturing creates or builds a new facility, um, you can normally a building is written off over 39 years, as Greg mentioned earlier in the session. But there's a special provision for, and I'll say manufacturers, although it's a little broadly defined, but manufacturers. So if they build a facility and instead of 39 years depreciation write-off, you can take 100% expensing of that facility um, starting now with the new law. So that's important. That's important to know. Tuck that away if you're in that business and you need to build something. The other piece is you want to look at the building itself that you're building and consider not only a cost segregation as Greg mentioned earlier to identify components of the building, but also when there's more than one activity within that building, you want to segregate the area that's what they call qualified production property versus maybe administrative stuff. But those are important things. So again, it's probably rare for folks on this seminar, but just know that it exists and it's a great opportunity.
Yeah. And I would say if you're thinking about building a building or buying a used building, certainly speak to us for some clarification and guidance. Is there are some rules that apply to previously used buildings that have had qualified production activities. So if they've been used January 1st of 21 through May 12th of 2025, then they may be ineligible.
All right. Polling question number 2. Does bonus or Section 179 depreciation impact your business decision on purchasing fixed assets? Or in other words, does the ability to write these off completely in year 1 affect your decision? Give a few seconds to answer. Wow. I thought, wow, 27% said yes, 73% said no. I would have thought it'd be the reverse of that. So interesting. Interesting. All right. Moving along. QBI. Who wants that one? Well, let me take it. I'll take it. So it was scheduled to expire. However, under the new law, the act, the OBBB, Act made this 20% deduction permanent. What is this? It's if you have a pass-through entity, you can potentially take a deduction for 20% of your income from that pass-through entity. And it was designed to kind of put the pass-through entity owners on even par or closer par to the regular C corporation tax rates. So a C corporation, a regular corporation, has a 21% rate, which is much lower than the 37% rate that Melissa covered earlier. And so this 20% deduction was intended to get those rates closer and more equitable, we'll say. And so the 20% deduction scheduled to expire. It's now permanently part of the code, which is great for a lot of middle market companies. So just know that it's still here. And then so for the gig workers out there, the Uber drivers, those 1099 type workers, there's if they have at least $1,000 of this qualified business income QBI, they could get a minimum deduction of $400. So it's a um, nice benefit. Trump accounts. Um, oh, sorry, I'm too fast. So I'll keep going with Trump accounts. Um, you may have heard. So for children born from 25 through 28. The federal government is going to put in $1,000 into a Trump account for the child. The key to this is when you file your 25 tax return, assuming you had a child in 25, or you may want to tell someone if you know they had a child in 25, you want to file this tax form 4547, and that kind of puts the government on notice that you had a child and to get ready for their $1,000. So it's a nice benefit. Um, there's although not directly related to Trump accounts, there's some other benefits we want to remind folks of. Employers can offer up to $2,500 as a tax-free fringe benefit sent to employees, essentially to pay for their student loan interest. So there's been a big focus on student loans and the impact it has on work, kids coming out of college, young adults coming out of college. So this is a way for employers to give them a tax-free benefit to pay their interest. And then under section 125, which is the tax-free generally cafeteria plans, you can your plan can be amended to allow for pre-tax salary contributions, but salary reductions into your dependent's Trump account. So they're trying to treat the Trump account similar to a retirement account. So if you're an employer and you want to offer these benefits, just consider amending your documents, your plan documents. And then another note before we come to the end, just in the benefit world, the bronze and catastrophic plans are now considered HSA compatible, which is great. So folks can use pre-tax money for that stuff. And then the same thing for direct primary care. I don't even know what that is, but I'm saying it. You can use HSA funds to pay those fees, whatever those fees are. So there's obviously some tax-free expansions under the new tax law. So all right, and I think that's our last polling question. Should we get into our last section? So, who do you want to win the Super Bowl? I'm guessing I know how those answers are going to turn out. I'm guessing 90-10. It's my guess.
Ooh, 7921.
80/20. All right, all right, a little bit off. It's pretty cool.
No.
Right.
All right, the kind of last two things to wrap up. So there's a couple new individual deductions for tips and overtime pay. Um, basically to for employer side, just be aware that they're out there and that 2026 will be required to be reported in the W-2s, but in 25 it's kind of a self-reporting. But I'm sure your employees, especially for the overtime pay, will be asking for some detail behind it. Most of the payroll companies that we've been talking to have the detail that they're readily putting on the last pay stub, and it's readily available for them. But something to be aware of. And then car loan interest, you can deduct up to 10,000 of interest on the personal use vehicle loans originated after December 31st, 24. This isn't all car loans. There's a whole list that we can help you comb through. If you've purchased a car, there's a few iterations of what loans actually qualify. So
I
a
think
full,
it's generally a car manufactured primarily in the United States kind of a thing.
yeah.
Cool.
And then lastly, the estate and gift tax. So the 15 million exemption is now permanent and indexed for inflation. So something to be aware of when you're looking over your estate plan. Just be aware that the state exemptions, depending on where you live, may not be the exact same height. So you still might have some gifting that you want to do. So review some credit shelters or bypass trusts. To see if you want to shift things around and change what your thought process was.
Yeah, with these, so real quick before we end, so I can die with $15 million in my estate, and I don't pay any federal estate tax, the asset-based tax. Um, my spouse can have another 15, so 30 million jointly, and if I die with less than 15 million, my spouse gets my unused up to 15 million as well. So that's great. That those were for many years. Those were in flux, and we did a lot of planning. But these are permanent, which is great, and they're indexed for inflation. So that's great. The other thing I want to point out before we close is the $15 million is an estate exemption, and but while you're alive, and a lot of us have heard about the $19,000 gift tax exemption, where anyone can give anybody, family members or non-family members, anyone can give anyone $19,000 gift tax free. The IRS doesn't want to know about it. It's a freebie. But once you go over the $19,000 in any single year, that $19,000 is an annual exclusion. But once you go over the $19,000, then you potentially you calculate a gift tax on the amount above that, but you don't really pay gift tax because you take away from your $15 million exemption on the estate tax. I bring that up because, again, we can give away $19,000 to family, friends, whoever. That's great per person. But the reality is you can really give away $15 million if you want. So it's a much higher, you can give more than $19,000. You're not going to pay tax. You may have to report it to the IRS, and you're going to take it away from the credit, the exemption you have when you pass away, because essentially you're borrowing from it now while you're alive. But just know that the gift tax limits are much higher than they kind of seem. Now, before you do that, please talk to your advisor, because there's benefits for leaving stuff behind, as we mentioned with these credit shelter and bypass trusts. You got to look at them. There's benefits for leaving assets to your heirs because of the adjustment in the cost basis when you pass away. So it's a more complicated discussion than just a slide, but just know that option's available. So with that being said, um, any final questions before we go? And I want to thank everyone for coming and for attending. And again, reach out to us if you do have final questions. Checking. Will Obamacare credits be will Obamacare credits be extended? Good question from Mr. Zubrow, our former boss. At this point, I don't think so, but there's always hope. So thank you everyone again for attending. Thanks for your time today. Be safe out there on the roads and have a great day. Take care.